What are the margin requirements for a diagonal call spread? Have you ever wondered how much capital you need to set up a diagonal call spread in options trading? Let's break it down in a simple way. A diagonal call spread involves buying a longer-term call option at one strike price and selling a shorter-term call option at a different strike price. This strategy combines features of both a calendar spread and a vertical spread. Now, margin requirements can vary based on whether you enter the spread as a net debit or a net credit. If you are paying to open the position, which is a net debit, the margin requirement is usually just the amount you paid upfront. This is because your maximum loss is limited to that initial premium. Brokers typically do not requiring any additional margin in this case. On the flip side, if you are receiving premium initially, which is a net credit, the margin requirement will be different. Brokers will requiring margin to cover the potential risk associated with the short call leg. This margin is generally calculated as the difference between the strike prices of the calls minus the net credit received, multiplied by the number of contracts. This calculation helps protect against the risk if the underlying stock price rises above the short call strike price. Another important factor is the expiration dates of the options. Since the long call has a longer expiration and the short call has a nearer expiration, the margin requirement can change based on how much time is left on each leg. If the short call expires before the long call, the position may become uncovered temporarily. This situation can increase margin requirements or risk. Brokers may treat the margin for a diagonal call spread similarly to that of a vertical call spread, but with adjustments for the different expirations. If the short call is held beyond the expiration of the long call, it becomes uncovered, leading to higher margin requirements and increased risk. In practical terms, if you buy a diagonal call spread as a debit, your margin requirement is typically just the initial debit paid. If you sell a diagonal call spread as a credit, you will need margin to cover the risk of the short call minus the premium received. This is often calculated as the difference between the strike prices minus the net credit, multiplied by 100 per contract. It is essential to remember that margin requirements can vary by broker and may depend on factors like account type, underlying stock price, and market volatility. Understanding these requirements is important because they affect the capital needed to maintain your position and your overall risk exposure. Diagonal call spreads can be a capital-efficient strategy, especially when structured as a poor man's covered call. In this case, the long call acts as a substitute for owning the stock, reducing margin compared to outright short calls or uncovered positions. However, always keep an eye on expiration dates to avoid unintended uncovered short calls and increased margin demands.